Don't go onto your deck and put your valuation on the deck, because that is a discussion point. That's the one thing that really turns me off, right? So ask a second question, which is, are they AI led or are they AI supported? In the region of 4,000 a year will approach us looking for funding. It's a lot.
There's not such good odds, are they?
Not good odds.
Hello, everybody. I'm here with Oli Hammond from Fuel Ventures. We're here for our first episode of Capital and Craft. Hello, Oli.
Hi, John. Thank you for having me here, mate.
Pleasure, mate. Yeah, we've got people dripping in already. We'll give people a couple of minutes. Whilst we're doing that, actually, I'm going to set the scene. So like I said, this is the first episode of Capital and Craft. Capital being fundraising and craft being the craft of building a product, not a craft beer reference. Although we may do something about that. Like we are planning on kind of meetups at some point in town and that sort of thing. So this is going to be a hot
opportunity, John.
What's that?
Sounds like a merch opportunity.
Well, it's all about branding and everything these days, and experiential stuff. And
they do it.
Yeah, that's it. So yeah, this is about this kind of webinar series, and hopefully in-person series, is about kind of going from that kind of pre-seed to seed to Series A, like where the sort of the meat and what typically seems to be like the hardest kind of hurdle to jump. None of it's easy, and building a startup none of it's easy, but this seems to be the hardest part, and that's kind of going to be what we're addressing today. And a little bit about us as a company, so Tappable, we are a kind of a 15-year-old engineering firm. So we've been around since 2011. We've seen quite a few changes in the industry. We've survived COVID. Our mantra is, and always has been, regardless of AI and regardless of how we're building products, is we're a partner, not a provider. And so that's what we do. So the format of today is we're going to be talking a little bit about kind of the building of the product and going from that seed to Series A. I'm going to be firing a bunch of questions at Oli, who's kindly joined us today, and then we're going to open it up to everybody else at the end for if they have any questions for Oli directly. So without further ado, Oli, thank you for joining us. Perhaps you could just give, I'm pretty sure that most people who are here today have heard of you or have heard of Fuel Ventures.
Yeah.
But for the benefit of the room, perhaps you could give us a little potted history on yourself and Fuel.
Yeah, absolutely. So I'll start with Fuel. So we are a pre-seed and seed fund. So we focus specifically on SEIS and EIS qualifying businesses. And we do that through two separate vehicles. We have a pre-seed SEIS vehicle, which does 250k tickets max, 30 to 40 investments a year. So hyper diversified, but very, very early stage. Alongside that, I guess we have our core fund, which is our seed fund, which is the fund that I manage. £1 to £2 million tickets, 10 to 12 investments a year. So still pretty diversified, but to nowhere near the extent of the pre-seed. Those are businesses that we've taken a more hands-on role in, although being a seed investor, we have to make sure we manage that quite carefully. Sector-wise, we're pretty agnostic. So our official investment remit is marketplaces, platforms, the SaaS model businesses, both B2B and B2C, which when you start pulling it apart is very, very broad. And that's by design. We want to make sure that we can diversify really well at the earliest stages, and we don't want to be too pigeonholed. Venture is all about opportunity and taking opportunity when opportunity presents itself. By operating quite a broad remit, we make sure that when opportunity comes, we are generally in a place that we can take advantage of it. We like to operate that quite broad remit. Founded by an exited entrepreneur, a guy called Mark, who founded a business back in 2007 called My Voucher Codes. He sold that in 2014 for about 55 million. It was not a venture business as it goes, but Mark was also quite a prolific angel investor, had a decent sized portfolio himself. And then when he sold My Voucher Codes, decided he wanted to formalise that process a little bit more, set up Fuel Ventures, is an investor in our funds, but is also a full-time member of our team. He's the CEO, does all the work you would expect that person to do on a full-time basis. I've been in the business now for nearly 7 years. Prior to that, I worked at a couple of startup companies, including another startup company that dealt with funding. It was in the crowdfunding space. I was there for 3.5 years. So all in all, I've been in startups for probably 11, 12 years, and specifically funding startups within other startup companies for about 10 years.
Okay.
This is an area that I've completely built my career on, and hopefully I know pretty well.
Nice one. So actually, on that, your specific role, how many startups do you think you would get involved with on a sort of annual basis?
Yeah, so investment wise, like I said, we'll do 10 to 12. In terms of
Yep.
how many startups do we see, probably in the region of 4,000 a year will approach us looking for funding. It's a lot.
There's not
There is
such good odds, are they?
not good odds, unfortunately. What I would say is that the attrition rate at 0.1 is incredibly high, right? Because
Uh-huh.
we get a lot. So if you look at our spread of portfolio, about 70% of the companies we see will come through our application form process. We have an open application so people can apply. We obviously look at all those applications as well. But because we are an EIS fund and because that process is an open process, a lot of those companies will come to us and they'll be from Australia, Bangladesh, the United States, Argentina, like all across the world, where people haven't necessarily appreciated that we've stated that we're an EIS and SEIS fund. In those
Yep.
scenarios, they'll fall out of the process pretty much straight away.
Yep.
Obviously, they wouldn't meet our remit. We're very heavily focused on the UK tech ecosystem. And that's about 70% of our deals. If you look at our portfolio construction, the majority will come from introduced. And that's just because that you have that first level of people who know us and know a little bit about us and what we like to look for, who will just do that pre-vetting for us a little bit. And if a deal's coming from an introduced party, it's many, many times more likely to at least meet our basic criteria, and therefore we're going to have a conversation with that company.
I've got a question on that actually, because you spend some time on LinkedIn, as do I, and there's a lot of conflicting advice and drivel and
Yeah.
advice about this sort of thing. And you just sort of answered a question that I had lined up, but you mentioned about like having an introduction. How how is a founder at that stage kind of getting that introduction, and who are these people who are introducing the founders to you?
Yeah, so it's a good question. In terms of the advice, you're right that I see advice on LinkedIn all the time that I don't agree with. That doesn't mean it's not applicable for the person who's giving
Sure.
it. So like
Yeah.
every fund operates differently, right? And actually, how I will make investment decisions in my fund will be different from another fund, and that's obviously what differentiates us. So I won't necessarily agree with it. And if anything, I'm like, great, that's a USP for me, how I'm different to this group. In terms of introductions, our most successful, there's two routes where what I would call our most successful introductions, and then you've got a longer tail. Our most successful introductions come from either an existing founder in our portfolio. We say internally that game knows game, which is basically
Yeah.
good founders know good founders, right? Like
Yeah.
that's how it works. They operate in good circles. So you've got, if one of our founders comes to me and says, I've got a company I want to introduce, as long as there is no like glaring, like this definitely doesn't meet our criteria, I will always take the phone call because of a mutual level of respect between me and that person who I know is a highly qualified person.
Yep.
Also from our investors. So for the investors in our fund, they obviously know us very, very well. They've obviously done their own due diligence on us. They come from high net worth backgrounds, so they're very well connected, and they've been very successful in previous careers, and they do a lot of introductions to us as well. Beyond that, other introductions will come from people like just let's just call them random people in my network. These might be people I know quite well,
Yeah.
but actually, like they're like, what are they? I can't put a title on it. They're just
Yeah. No.
someone
But
who's like,
the same goes for the sort of the high net worth individuals, because they're sort of not necessarily, they're not always the people who are shouting about it from the
yeah,
rooftops. You know, they could
absolutely,
be like, you know, an investment banker who's just diversifying their portfolio. And
absolutely, absolutely. Like they're just people who know people,
yeah.
and so we get quite a lot from there. There are professional introducer networks, and I
Hmm.
do see deals from those networks. Those are sometimes a little bit harder because they're not necessarily people that I know on a personal level. I know that they're people that are trying to push out as many deals as possible from a commercial aspect. Doesn't mean they're bad quality, but just like in terms of success rate, subjectively, I would say my success rate from those is a lot lower than it is from someone who I know personally, or someone who I know, even if they've got some kind of interest, like financial interest or something like that, is someone who knows our criteria quite well and is probably going to be unwilling to waste their time on just pushing the deal out to everyone.
Sure. Yeah. So I'm taking from this that founders need to just network with other founders and as many investors as they can. But that's harder. Just and so you talked about like game knows game, like, and so I have this thing where like I talk to good founders and talk to founders all the time, and I find that when you speak to a good founder, you just know. Well, I certainly get that feeling, and I'm not an investor, but like from an investor's point of view, what is it that kind of like I can't really put my finger on it because I've talked to so many good founders, and I'm just like, yeah, this
Yeah, you
person's
can't.
they just got stars in their eyes. You can just tell.
Yeah, you can't. And I would say that one of the traps that I fell into in the early days of my career is, to an extent, being too gullible, right? And in that instance, because when you work in venture, it kind of falls under the analogy that when you're a hammer, everything looks like a nail, sort of thing, right? Like when your job is to speak to startups and you're early in your venture career and you want to, I'm a believer, right? And actually, that's why I work quite well with with Shiv, who's the other partner for the fund. Shiv's a natural pessimist, and I'm a natural optimist, right? So, and that works quite well together. That blends quite nicely because sometimes I can get a little bit lost in the clouds, and Shiv brings me down. And sometimes Shiv can get a little bit lost in the weeds, and I have to bring him up.
Yeah, great.
And it works quite well. But I think in the early days of a venture career, you tend to be more attracted to good salespeople.
Yeah.
So when you're defining what a good founder, and sales is important, obviously it's super important, right, in terms of the business, but in terms of like future funding rounds and things like that, you need someone in the business who can present the business in its best light. Because when you're investing into a company, it's not about, do I just think this is a great company? It's, do I think the people behind the company are thoroughly investable? Do I think that this round becomes super competitive at Series A and Series B? So having that voice in the room is super, super important. But in an early days of a venture career, it can be very easy to waste time on people that are naturally good salespeople and can't necessarily back it up. And you can spend hours of your time looking at businesses, and then at the end of it comes to the conclusion of, oh, it's just not as good as sold. It's not, it's not sold to me because the person was a good salesperson. Likewise, it can be very easy to ignore people who are relatively poor salespeople, but maybe who come from other backgrounds, right? So the common situation, not always, but the common situation is tech people, right?
Yeah.
Tech people, in my experience, tend to be quite poor salespeople. They are technically minded. They are not creatively minded. I think that's a bit hard, but you catch my drift.
Yeah.
And so what they can do is they can quite easily undersell themselves, or what they can quite easily do is get so caught up in technical jargon that no one really understands what they're doing. And they struggle to sell the business because they sort of work on a level where they expect everyone to understand what they understand. So that can be quite problematic, right? So you kind of need both. And I think as I've got later into my career and I've seen loads and loads of decks, it's become easier for me to define founders that don't have particularly strong sales ability or pitch ability, but are building something interesting because I've got lots of comparisons that I've worked on over the years. Early days, that was harder. So I would say what makes a good founder is action and the ability to build something or sell something very, very well. But when it's in a half-hour presentation, defining who that person is very easy to side with the salesperson than it is to side with the technical person.
Yeah, agreed. So when people are coming to you and they sort of get these meetings and they come through and that you're progressing your chats, there's an interest there. What have they got typically? Like in terms of what I mean by that is, have they got like how much of a product have they got? How much revenue are they doing, if any? What at your stages, what's important to you?
Yeah, so at pre-seed can be super early, right? So when we set up the pre-seed fund, and I have this conversation with the pre-seed team all the time. Pre-seed is about giving money to interesting people. So they probably got some kind of MVP. They might have some very early customers, some very early revenue, £2,000, £3,000 a month sort of thing. But really what it is about 80% of your decision is completely defined by, are these a group of qualified people? And if so, if they're a group of qualified people building an industry that you think is interesting, that's kind of the limit. Because at pre-seed, there's a couple of things that One, the product's not going to stay the same, right? That product is going to be thrown out the window probably several times, right? Like that's how it goes. Two, that the market is going to change probably significantly in the time they go on to building a very, very significant business. And you need to have belief that these are people that can change product, can pivot, and can manage that process. And three, it's that you need to have some kind of level of belief that this is a group that's going to at least stick together. And so and that comes from quality. That comes from an idea that everyone's pulling their weight. Like the biggest founder fallouts that I see is when people feel like others aren't pulling their weight but are getting same reward and same equity for So how you mitigate risk at pre-seed is not by due diligencing a company to death, because that is how companies die. Like you take them on a 5-month-long process as a pre-seed business, that it's very, very easy for them to fall out. It's by finding really good people, giving them money, and then diversifying your portfolio really aggressively. So that's why our pre-seed portfolio will do 30 or 40 investments a year. On a seed side, there is more work that goes into it because the companies are generally more progressed. So generally, we're investing in companies that are doing £10,000 to £50,000 of monthly revenue. And I say monthly revenue, might be recurring revenue, that might be marketplace revenue, so it might be a margin on GMV, because we're quite broad in terms of what we invest into. But they will generally be doing some kind of revenue. We do target business because we write quite large seed tickets. 1.5 million is our average. We're looking for businesses that may be a little bit more progressed, do have some kind of revenue coming in. They haven't necessarily proved product market fit yet, as it were, but they have at least people that we can go to discuss. And I guess this comes down, I know you will have some questions about technical due diligence.
I do. I'm just about to get onto that.
Well, maybe I'll save it then, because I'll leave it at that, and then I'll save what I'm about to say for when you have any questions about that.
Well, I've got quite a few actually, and before I go on to my next questions, what I should say is, hi Javid, to everybody who's watching. If you have questions that come up throughout our discussion, chuck them in the chat, because I will be firing those questions off. And do feel free to introduce yourself as well. Like, so, hi Javid, from Total Halal, food delivery. So introduce yourself, put a question on, we'll read it out, and so Oli will kind of knows you as well. It was going to be a little bit about that kind of seed stage due diligence. That's interesting to me, because if I'm doing 10 to 50,000 pounds of revenue, is that on a vibe coded? Like, we're going to have to touch upon AI and all this sort of stuff now. It's probably not, right? So maybe we take a step back and to kind of get from that pre-seed to seed. I imagine if we're talking about that pre-seed, I can probably come to you then, based upon what you just said, with a sort of vibe coded thing that I've put together with, a few mates, and we've got a vision and we're throwing it out there and we're testing it with the market, and we'll show you how awesome we are, and now give us some money, and then we'll go and build it correctly, or, whatever you want to call it. Is that a fair assumption, or am I miles off?
It's a reasonable assumption in the modern world. What I would say is that with even at pre-seed, one of the things that we will always consider is things like, and again, I don't invest at pre-seed, I do seed, but so I'm speaking for another team here, but I've obviously looked at quite a lot of deals. So vibe coded solutions are okay as some kind of proof of concept, right?
Yeah.
But what I would say is that even within a team at pre-seed, where obviously the majority of focus is going, there will be some kind of question around technical know-how within that team.
Okay.
So if the pre-seed team is looking at a company and going, right, so you're trying to build a relatively technical solution for XYZ industry, how does this develop beyond pre-seed? How does this develop beyond vibe coding strategy? This is a proof of concept. This is something that you're trying to show that you can make it work, or what it would look like.
Yeah.
I would say that if there was any question about technical competence within the team at that point, then they're probably not going to back it. If it's a group of sort of salespeople who are trying to vibe code something and then trying to raise money to bring in technical know-how, it's probably not something we're massively interested in. The reason is because again, something we've learned over the years. Salespeople are super important, but they're super important for sales, right?
Hmm.
Where they kind of fall short sometimes, or where they kind of fall short a lot of the time, is understanding the restrictions in build, right? In dev
Yeah.
build. So it's all good and well if you've got a group of salespeople who are like, right, so this is what we've done. We vibe coded this. It's really basic, V -1, but we this is what we want to build, post, and we can sell it.
Yeah.
Okay, great, but you don't know whether the technical restrictions on what you're trying to build exist. You've got no concept of what the technical restrictions.
But so what? I'll just interject there quickly. People like us, Tappable, do. And so what about a great salesperson and someone who can kind of, fly a business and then using the money to give it to a partner like us who does know how to build? Is
Mhm.
that just not interesting in the slightest to venture capitalists? Or I mean, because I know people who've done it. Like for instance, Callum, you may know him, Callum, the founder of Wineify. They're going great guns at the moment. Like that, he did that, and he's built that business. He's a salesperson and a damn good one. And he's one of those founders who's just like you see him. He's just amazing. Um, so he's done that. He's taken his business and he's flown it, and then he's got to that point where I think he's just doing like late seed now, where he's now bringing in kind of more technical people. But at that kind of seed stage or post pre-seed, he's brought in a team,
Yeah.
helping build it out.
So what I would say is it depends on what you're building. So I also have businesses in my portfolio that use agencies. I'm sure if you have an agency, John, but I will use the word agency. They use
Agency slash partner.
agency slash partner, right? So they use these
Yeah.
third-party partners in order to help them manage their build.
Mm.
As long as the IP for that build exists within the company,
Yeah.
then I'm kind of okay with it. I've done it before. I'm kind of okay with it. It's not my ideal. I'll be honest.
Yeah.
It's not my ideal, but I'm kind of okay with it as long as the IP sits within the company that I'm investing into. There's also a question about what's the form. I can't think of what the formal question would be. How complicated is this business, right? So I
Yeah.
know Wi-Fi a little bit. I looked at it. It wasn't a business for us, but like no problem with the business itself. Like it just
Yeah.
wasn't for us at the time. What I would say about a business like that is that their USP, the value that they bring to people, is not a technical value, it's an access value, right?
Yeah.
So it's access to a certain market, right? They're like, we've got access to these people, we've got access to these markets, we've got access to these suppliers. Like that is our USP. The technical part of the product is not a USP. So
Right.
if you said to me, do you think that you could build, I'm not sure if this is still the iteration of their product, but do you think that I could go away and spend money and build a marketplace style platform that connects wine collectors slash drinkers to wine suppliers? Yeah, that's completely
Yeah.
doable. Like that's
Yeah.
not there's no jump there, right? Like
No.
I go online every single day and I go on Amazon and Claude and Gmail and Pipedrive and blah, blah, blah. The concept of you building a platform that's a marketplace connected, like
Yeah.
that's completely believable, right? Like that
Yes,
concept, I
exactly.
know even without my technical know-how, I know that can be built. Like that's not a stretch. Where it would become more important in terms of technical due diligence becomes more important in unbelievable outcomes. So it's a case of like, we are building a brand new system to XYZ.
Yeah.
We are building a brand new cybersecurity platform for XYZ. When you're saying what we're doing is we're pushing the frontier of technology, that's where technical due diligence becomes more important, because what I don't have in that instance is is tons of clear examples. If you said to me I'm building a new form of CRM as a SaaS platform, great. I know CRMs exist. I use them every single day. The idea that you do something different within that platform is not beyond the bounds of imagination. So as long as you are competent and qualified human beings, I can appreciate how that could be true.
Yeah. Yes, that's actually really interesting. So it's where kind of tech is the core product, as it were, rather than just sort of bringing people together. And actually, on that, let's talk about AI. I imagine you've seen quite a lot of
Yeah,
AI at
everything,
the
mate.
moment.
Everything that comes across my desk at the moment. AI for this, AI for that. Yeah,
Yeah. So the last one on that, the AI thing, because there will be AI founders here.
of course.
What do you just get do you do a bit of a eye roll when you see an AI thing, or how are you differentiating from true AI versus someone who's just wrapped
So, yeah. So on
AI
your
and
first
called it
question,
a new product?
yeah. So on your first question, do I eye roll? The answer is no. And the reason
Good.
is because so there were times that I did. I've been through several hype cycles now, right? And the last one, I mean, we went through the in 2021, we went through the crypto hype cycle, right? Now, I was never a crypto maximalist, right? Never a massive believer in the market.
Hmm.
People can call me stupid and all that for that, but I just never was, and Fuel never was. We never had very strong concept on crypto. We were very
Yeah.
much of the belief that there is a group of people out there that do and will invest in that, and we're not those people. We're not going to invest in the winner in this space. AI is very, very different. And this is why AI to an extent is more dangerous, right? Like
Hmm.
for the investment community, it's dangerous for the investment. We're in the most dangerous period of private sector investment in the last 10 years.
Never heard the word dangerous used. That's interesting.
Yeah, we are. My view, that's
Dangerous how?
my view is that we're in very because it's too easy to believe.
Hmm.
So when the crypto revolution came along, right? Like I said, in the early 2020s, there was a lot of criticism directed at the venture market. And that criticism was very much like, um, you're throwing money down the drain, it's a waste. You know, there was a big split in the camp, right? The
Yeah.
reality of the situation is that very, very little, very few venture pounds, dollars, went to the crypto market. And generally, if they did, they went under very prescribed crypto funds. You know, Andreessen launched its own crypto fund, and so did some other big investors. And those haven't worked out, right? On mass, haven't really worked out, right? Because as people will know, the crypto market's been absolutely battered.
Mm.
But that wasn't the majority. And the majority of people, if they did invest in anything in crypto, they did so as a small part of the bigger portfolio.
Yeah.
It was managed. The problem that we've got now is that we operate in a market where there is no one that I know that does not believe, right, that this is like the next big technical evolution.
Hmm.
And and what that means is that the wool is easily pulled over the eyes. And people are so desperate to get involved in the market. And by market, I don't think AI really is a market. AI is a technology, right? The market, the sector still exists, fintech still exists, and prop tech still exists, and enterprise software still exists, and all that still exists. AI is just a component in all of them, right?
Yeah.
But the belief that they need to get involved in these sectors is so strong that people are now making decisions that maybe aren't the best decisions in order just to get access and exposure to what they see as AI-led companies. Because if they're not getting exposure to those companies, their investors are asking why. Like, why are you
Yeah.
missing this? Why are you not involved?
Yeah.
And I think that what that's going to lead to is like, that's going to lead to a lot more companies that trip
Mm.
over, and it causes problems.
Yeah. So do you guys, how do you mitigate that risk on your side? Have you got kind of like a lot of people who are doing some serious tech due diligence on the AI side to actually like vet these people and that they're actually like there's something there?
Yeah. So the first thing is that we've got an AI. We run an AI strategy, right? So historically, we've always I can like, listen. I can a big part of this business, right? I can criticize loads of things that we've done in the past, as any person that owns a business can, right? We can
Hmm.
always say like, oh, I should have done this better. That's life. One of the things that I think we did really well in the early days is that we took a step back and we said, what the hell do we want out of this market? Like, what do we
Hmm.
want? So what we do now is that there's a split, really a split. So what we used to do is we used to say about all of our companies, what sector are they in? Are they a fintech? Are they a prop tech? Are they an enterprise software company? Are they a gaming company? Yada, yada, yada. We now ask a second question, which is, are they AI led or are they AI supported? Right? Now, an AI supported company is a company that uses off the shelf AI software in order to generally cause some kind of improvement in gross margins, right? And
Yeah.
that might be improved customer experience, that might be improved product development, that might be something like that. But it's background, and they might have a chatbot, you know,
Yeah.
for the customers. But it's a business that could have existed pre AI revolution with some AI support, which means that gross margins can increase. That's generally
Sure.
what will happen. The second category is AI led businesses, and these are businesses that are companies that sit at the forefront of AI and probably couldn't have existed, especially in their current state, without what's happened over the last 2 or 3 years
Sure.
occurring. And we're looking at companies on that basis. For companies that are AI led, we are generally only investing into. So when the market really started picking up, this probably mid to late 2024, what we started seeing was this flood of companies in the market that were generally around three sectors: sales, top of sales funnel, tools, things like that; marketing, automate your marketing, automate content, blah, 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 blah; recruitment.
Yeah.
Those were three that we saw, and we didn't invest in any of them. And the reason was not because we don't think you can build a decent business in these areas. We struggled with the venture story, and we also struggled with protection. We're basically big believers that the LLMs platforms, Anthropic and OpenAI and all of that jazz, they are going to be under significant pressure to make money now.
Mm-hmm.
And what they're going to do is they're going to target a broad remit of unregulated industries. And so what they're going to do is they're going to be the platform where you run your sales tools or your marketing engines or things like that. It's easy for them to get into, right? They've got all the information that they need in order to do it, and they can run those agents themselves. So we were big believers that where we wanted to invest was in regulated tech.
Cool.
So businesses that operated within regulated markets, because our belief is that where those LLMs stop is when they start hitting regulation. Because they can't manage regulation across multiple geographies. They don't want to. It's expensive. It's a pain. And what they're going to do instead is they're going to hit the regulatory barrier, then they're going to go horizontal again, and they're going to go somewhere else, and they're going to run agents there. So the majority of our AI-led investment strategy since late 2024 has been dedicated to AI-led businesses that operate within regulated industries.
Cool. Interesting. So I'm going to leave it there from my point of view. I'm going to sort of throw it over to some of the questions that we've had coming in. There's a few actually, so we'll try and keep it fairly succinct. So we've got a question here from James. So last year, I saw the rise of investing into holding companies largely in the USA, where a founder tries a lot of ideas and precedes invest in the founder. In today's market, that's kind of what modern venture studios lead builders are doing, building 10 products, marketing 10, and 2 winners survive. Do you think they are investable in 2020? That's a cool question.
Yeah. So it's an interesting one as well, because actually we've from our pre-seed fund, we've actually just done this. So
really?
I've got a little bit of experience in this area. So one of the areas that we've been very successful in historically is what we would call roll-up businesses, which are businesses that raise quite significant seed funding and they roll up smaller profitable businesses. And one of our biggest companies is a company called Abingdon Software, which I think is approaching about 40 million of revenue. They were pre-revenue when we invested in October 2022. So like they're growing very, very fast. So that's roll up, not necessarily venture builder, but roll up. To James's question specifically, the answer is yes. The idea would be that we are now in a market where you can iterate multiple ideas very, very quickly. Vibe coding, we talked about it a little bit, John. My big question about this industry is, and what they'll do is they'll reference people like Rocket Internet and stuff like that. Now, the problem with people like Rocket Internet is they invest off their own balance sheet, right?
Yeah.
As an investor, one of the big questions that I have is, how do you manage equity in these businesses? So let's say you have 10 businesses and 2 become successful, right? You've got whatever your barrier is, right? You've got 10 businesses, they hit a wall, and then the wall decides it's a filter, right? Do they make it through the wall, or do they hit the wall and die, right? And that's for every individual founder in this space to decide. If they filter through the wall and they become successful, ultimately what has to happen is they have to spin out. So what has to happen is the person who's running the venture builder has to let go of the baby and has to give the baby to someone else to manage and run and hopefully make their fortune from. So one of the big questions that I have as someone who, whilst we've done it a little bit of pre-seed and we've taken a look at it and we've actually made an investment, I didn't run the process for that because I'm a seed investor. But were that business to come to me tomorrow, the big question that I would have is, how do you run this from an economic standpoint to make sure that we as investors have enough economic interest in the success in these successful businesses to make it valuable to us, whilst at the same time keeping these businesses suitable for, i.e. enough equity for their CEOs, who are not necessarily their founders, but their CEOs, And also, if they, for example, wanted to raise venture funding, like how do you make those
Yeah.
capital work? That would be the big question that I would have, and they may have some kind of theory around that and about actually no, we're not looking for venture funding for these businesses or whatever it might be. But that would be my big question. Are they investable though? Yes, and I do see them raising investment.
Wicked. Okay, cool. We've got quite a few questions coming through actually. So, um, someone like that. Phil, I know Phil, good founder, investable people, interesting people. They're 80% of the decision.
Yeah.
What's really at the heart of the decision you make about the right person team? This is Phil. He's a mentor and he's author of Angel Think.
Yeah, okay. Phil, it's a good question and it's a subjective question. So if we all worked, if this was an objective question, then I would probably be out of the job. Let's be honest, because if this was measurable, then it would be a lot easier. So what I would
There's a
say,
gut a lot of the time.
there is a lot of gut that goes into it. Obviously, we spend quite a lot of time with these founders and we talk to these founders. I do have a scoring system. I do
Okay.
run an internal scoring system for founders. It's a scoring system that scores founders out of 15, founding teams out of 15. And it breaks it down into some very simple categories, right? Stuff that we know has positive impact on potential outcomes. So stuff like, what level of education have they had up to? Or how many founders are in a team, right? We know that we know that sole founding teams are less likely to get unicorn outcomes than multi-founding teams, but there is an exponential drop off after 3 founders. So if it's a founding team of 2 or 3 people, that scores highest. If it's a single founder or if it's a founder of 6 people, that scores lower. It's stuff like that, and it's indicative, right? So I might have a founding team that gets 13 out of 15. That doesn't mean I'm going to do the deal, but it's just so that when we discuss it at an IC level, there's a very, very clear markers of these are what we believe are strong indicators for founders and founding teams. How do we feel about that in the context of the business?
Yeah.
So it's a very, very important, and ultimately what it comes down to is when we consider that score and we consider the time that we've spent with these founders, they've been answering our questions, they've been engaging with us, they've been showing us documents and forecasts and decks that they've produced. How do we feel that this represents what we see here in terms of quality? It's a comparison. It's a comparison situation. So we try to measure it a little bit without making it a core part of our decision. And ultimately, what it then comes down to is when we consider that and we consider the interaction that we've had with the founders, how do we feel about it? If we work with a founding team that scores highly objectively on the qualities that we see as good within strong founding teams, and we're super confident that the quality of their responses is very high, they get back to us quickly, that they think outside the box, and when they're answering questions, it's not like a linear process, it's a broader process. They've got an idea of who they need to hire, i.e. they know their weaknesses within the team and who they need to support them. That then makes us much, much more inclined to do the investment.
Wicked. That's a great answer. Okay. One from Javid here, who we spoke to earlier. Hi, Oli. Have you invested in halal or growing Muslim market in Europe, US, and Canada? Sharia compliant products. Quite a specific question, but
yeah, it's very specific. The answer is, have we ever considered it? We've looked at it. We've never done an investment into the area.
I suspect you're going to get a pitch after this then.
Yeah, I would say that, and this is not a view of Fuel Ventures. This is my view. It's an area that I struggle in a little bit, and only because Sharia is defined by religious law and obviously interpreted by, I would say religious professionals, but you catch my drift. People that it's not an area that I know. I don't know who these people are. I don't really know what defines it. My interpretation is that it can change depending on whoever's interpreting it at the time. And I don't necessarily think that I can appreciate the service that people that need to follow that process need. Which makes it a bit harder for me to really, really appreciate it. So it's not something we've done in the past. Is it something we do in the future? Yeah, maybe. It's not something that we've ever ejected ourselves from. It's harder for us as a team to make sure that we fully appreciate the needs of that community. Which makes it a little bit more difficult. But
And you want to add value, I suppose. So
Absolutely, like we
yeah,
want to add value, you know, that's an important part of what we do.
yeah,
You know, if we feel like we can't add any value, that becomes quite restricted as well. But
cool.
yeah,
Okay, cracking on because I've got to try and be rapid fire. Because we've got another three to get through, a couple of minutes left. Kevin, hi, Ollie John. If you had to name top 1 to 3 things that put you off an investment when you're doing a first pass review on an opportunity, what would they be? Oh, this is a brilliant question. Love
yeah,
this one.
things that put me off an investment. So so I'm trying. I've
I can
got. I
tell
mean,
you one that I see a lot is know-it-all founders.
yeah.
And but they just don't want to be told anything, like, and they kind of come and they know it all, and it's
Yeah,
just like
exactly.
it's off-putting. And I'm not even an investor, and like
But
if an investor kind of speaks to a know-it-all founder, it's
it's
just
quite
like nah.
difficult, right? It's quite difficult because I agree with you, John, but also at the same time, there's two things there's two things that are relevant here. One, my job is to be the most ignorant person in the room, right? To an extent,
Hmm.
right?
Hmm.
Like my job is to find people much smarter and more competent than I am and give them money. It really is that simple. So the idea of like a know-it-all founder is that's kind of the person I want. I want the person that knows a lot more than I do.
Yeah,
I would also say that actually, in being a founder, there's a really difficult line to walk, which is a humility versus
that's more the line I
humility
was talking about. That kind of
right. Like
yeah,
to be a really successful founder, you need to be a little bit unhinged. Like you just
mm.
do. Like it's
Yeah, they are crazy.
job, and you need to be a little bit unhinged in order to be like really, really successful in that. And by unhinged, I don't mean bad or mean or anything like that. I just like you need to dream the way that a lot of other people don't dream, right? You need to
Hmm.
do things that most other people won't do in order to really achieve what you need to achieve. So when you've got people who are so what I would say to that is I don't mind someone who has real confidence in their answers and their responses as long as they can back it up, as long as they can be like, and the reason that I think this is I've done X Y Z, um,
Hmm.
when I was doing this all this proved to be right. Fine,
Yeah.
great, lovely, like let's have that conversation. So I don't really mind that. I think the things that really turn me off. So the first thing that turns me off is because I'm trying to rank them. That's my problem. It's not that I don't have
Mm.
things that I'm trying to rank
Let's
them.
just go with one because we've got a couple more questions. So the number one, the
Okay,
one that you,
the number one mistake that turns me
y-
off at the point
yeah.
that someone reaches out to me is when they have valued their business on the pitch deck and the valuation is mental. That's the one
Okay.
thing that really turns me off, right? So they've got this business, they're raising seed, they're doing 100K of ARR, and they want to raise 5 million at a 20 million pre.
Hmm.
That really turns me off because I just think that like the because I'm never going to take the call because I know that the difference between what I even if I liked the business, the difference between what I would offer and what they think that the business is worth is so
Too
drastic.
far apart.
We're never going to find a middle ground. It's never going to
Yeah.
happen.
Yeah.
So I would say that that's the thing. I always say to founders, don't value your business. Don't go onto your deck and put your valuation on the deck because that is a discussion point. It's not for you to value the business. It's for your investors to value the business as part of a discussion with you. And either what you're going to do is you're either going to overvalue yourself and scare people away, and you're not going to have the conversation like I just said there,
Yeah.
or you're going to set a ceiling. Like
Mm.
if there's a pitch deck that says I'm valuing this business at £6 million pre, if it says that on the pitch deck, no one's going over that.
Yeah.
So I think you do yourself a disservice either way by doing that. But it's the ones that come in with crazy values and stuff like that that really that really turns me off at the earliest stage.
That is a great answer. Just don't put a valuation of that. Okay, we've got Nitin. When you see a company with decent traction, but it's still in that awkward space between that late pre-seed and seed, what specifically makes you believe it can grow into a fuel-sized investment rather than just stay a good small business? I love this question.
Um, so so one of the questions that I will always ask founders that I speak to is, what's your ambition? Um, Fuel me. I am not the arbiter of good or bad businesses. I'm just the arbiter of businesses that are good for us. There are plenty of businesses. Most businesses that exist out there are fantastic businesses that aren't suitable for Fuel Ventures, right?
Yeah.
If you build a business that is worth £50 million, that is not a business for Fuel Ventures, but for you, that is a fantastic business, right? And it creates generational wealth, and it very, very impressive. Like, does more than most people will ever do. So ambition is super, super important there. So if I have the call with the people, if I have the call with the founders who say, so the first thing is I have the call with the founders and I say, what's your intention here? What do you want to do? Oh, well, we want to reach 10 million of revenue in 5 years. Great. Fantastic business, not one for us. Like, the scale is just, the outlier scale is just not there for what we want to achieve. It's a different path. It's a different path that you're trying to achieve. And that's fine. That's not one for us. If they come to us and they say, oh, no, our intention is to build a venture scale business, then how do I define whether it's a good or bad for us? Now, one of the things that I think doesn't get taken into account enough when people talk about venture funding is risk profile. So I've got businesses that I would say are probably in that space, who are between pre-seed and seed, but that we've done an investment into. But that's not because I specifically think that business is better than all the other businesses that I've done. Obviously, I think they're great businesses, otherwise we would never have invested in them. But I would say that it's because they probably presented a case where, from a risk profile perspective, it became easier for me to believe. So actually, one of the businesses that we did this year was a business called Lock AI. They are a business very specifically that deals with 2 rocket scientists, and what they do is they save businesses inference costs by running simple AI processes off the hardware that you are using. So if you have an AI-led product, or if you have an AI consumer product, and the consumer wants some kind of AI response, whatever that response might be, rather than pulling from the LLM itself every single time that a request is made, what it does is it uses the hardware to run simple AI responses, and therefore save you token and inference costs.
Yeah, the token costs. Yeah, nice.
So super interesting business, a little bit early for our seed fund, but we loved it. So what we did is we did a 800k ticket into that business. So even though it was earlier, that was then represented in my risk profile. So 800k is about half of my current average ticket size. And so what we could then do is afford to fall in love with the business and the people that were building that business, and then represent it proportionally as risk within our portfolio. If the company does well, then obviously our investors get an outsized return from that. If the business doesn't, and the business fails, and it was a little bit earlier than we needed, then actually the risk is mitigated, because we're talking about a smaller ticket, and we can run that risk mitigation. So in scenarios where I find businesses that I think sit in that gap, I can manipulate ticket size to manage the risk in that regard.
Wicked, cool. But as a first pass, you're looking at where their heads are at in terms of their scale and that sort of thing.
Yeah, we need to understand what they're trying to achieve, because if they're trying to achieve good business but not VC business, absolutely fine. VC is not the only route to successful business, obviously. And that's fine, but we just need to know that from early doors.
Yeah, if they are trying to achieve what you described there as good business, and they want some money, where do they go then? Just a loan or something like that?
You can go loan. Obviously, if you're trying to run a business that's profitable, you can obviously go down the loan route.
Because what you've said is a common theme throughout VC. Most VCs are not looking for those kind of like healthy, good businesses. That they want something that's going to fly.
Absolutely. So you can go down the loan route. You can also go down the angel route. Remember that angels have different. The economy for angels is different than the economy for VCs. So the reason that VCs rely so heavily on outlier exits is because in order to make money, VCs need to return money on entire portfolios. Angels don't have that restriction. Angels can return money on individual deals and still profit significantly from those. Whereas I, as a VC investor, I have to return 1.2x my portfolio value before I ever see any money made from that.
Yeah.
So the economics for an angel versus the economics for a VC are different. And so you might still be in a situation where you can raise 200, 300, 500,000 from angel investors, even more maybe, depending on what your locale is and the local angel groups, than VCs. So
Wicked.
you can look at those as well. And alongside that, obviously, there's still a significant market for, like I said, debt and things like that for profitable businesses.
So, last question, because I appreciate we have run over a little bit, but thank you for that. Is from Alex. So this is Alex from Simply AI.
Yeah.
With 4,000 inbound decks, do you now initially score using AI to review the deck? And if so, to be passed over to humanize, what the score you'd use? And then a sort of second question along that is, what's the venture thinking around business age? We are 3 times Innovate winners 2020, 2024, but had to pivot from XR, no revenue, pull through at scale before finding PMF in AI application layer for telecoms.
Yeah.
Positive is founder journey and commitment, downside age by incorporation date versus shiny and new.
Yeah, okay, got you. So to answer the first question, the answer is yes. We are doing more and more of that now. We've got a model that's a new model that's going live within our application process. I don't know what the final number for that is yet because we need to test that model before we get to the final number. In my head, it's probably going to be 75%. So we score
Yeah.
all the companies out of 100% based on our criteria and what we like. If a company hits 75% or more, we commit to a call with that company. If not, then we pass on that company. It is only for first wave. So it's only for like that first individual, like, is this company going to be of interest to you? Beyond that, we still run human process because we support AI in some of our internal actions, but we still run human process within those processes. To the second part of the question. Now, this is a really interesting question. It's not a question that I get asked a lot, but it's actually a very, very interesting question because age is one of those things that people actually in venture land take quite seriously, because it's all about velocity. One of the biggest drivers of investment in startup companies is velocity, right? It's not just about like, oh, is this a big company? Is this company doing 5 million of ARR? The question is, how long did it take this company to get to 5 million of ARR?
Right.
So if you're looking at a company that took 10 years to get to 5 million of ARR, that's much, much less attractive than a company that did it in 2, right? Obviously. And that's then reflects obviously in valuation. So velocity is actually really, really important. What I would say is that if you're in a situation, that's done on a product basis, not necessarily like we founded a company basis, but a product basis. So if you're saying we founded a company in 2020 and we pivoted in, sorry, John, did you say the date when the company?
Yeah, I did. It was 2020 Innovate winners. So they were Innovate winners in 2020 to 2024.
Yeah.
Then had to pivot.
Yeah. So pivoted in 24.
Yes.
Yeah. So if you said to me, we've been around since 2020, but we pivoted in 2024. And we've been growing for the last 2 years. And in those 2 years on our core product, we've gone from 100K of ARR to 1.5 million of ARR, hypothetically. I would say, okay, great. Well, that's really interesting because that's presenting some significant velocity.
Yeah.
Also, if I'm as a seed investor, if you're saying like, oh, we've got to 300K of ARR on this core product across the last 12 months, also very interesting. I don't really care about the previous 4 years to a certain extent. The only way that it would affect me is if the company, if that had some kind of impact on EIS, for example, because EIS is obviously a date threshold. So I would say that people tend to care more about product than they do about age. Age is only important in regards to velocity of growth if we're talking about the same business in the same product. How it may affect you negatively is if people don't have the chance to have that conversation before reviewing that information, and they might see a business that's been around since 2020 that is doing XYZ revenue, and they don't necessarily appreciate the nuance of that switch in product.
Cool. That has been brilliant. Yeah, thank you, Alex. Glad it was helpful. Ollie, this has been brilliant, and we're gonna end it there because we have actually run over a little bit, and I hope everybody has enjoyed this session today. Just as a recap, Tappable is we're going to be running these once a month, and everybody who signed up will kind of get show notes, and they'll get recordings of all this, and we'll obviously post it online. But you will get write-ups of all of this. And Ollie, if anybody wants to reach out to you, which I'm sure they will, What is the best way? And we've discussed how to maximize your chances. So hopefully some of these people have got an intro, but like, how can they find you? Is LinkedIn probably the best
Best
place
way
to
is
find you?
LinkedIn. Oli Hammond LinkedIn. I spend a lot of time on LinkedIn, as you guys can imagine. So
Yeah,
that's always the best way.
appreciate it, Ollie. Thank you everybody for joining, and look out for those notes.